Our next guest joins us from the NYSE in New York, where he'll be giving a keynote address at the Inside Commodities Conference later on this morning. Famed economist Nouriel Roubini, the chairman of the Roubini Global Economics Monitor blog, as well as professor at NYU Stern School of Business, joins us this morning. Nouriel, good to have you back on the program. Good morning to you.
Good morning, Carl.
You were with us a couple of weeks ago here at this desk with me and Becky. We talked about this giant carry trade, the mother of all carry trades, as some have put it, and it makes the front page of the Journal today. Fears of a new bubble as cash pours in. Are you seeing any turn in that trade? Is it either getting larger or smaller, staying constant? What's your view at this point?
My view is that this carry trade is becoming actually larger than before. In the U.S., the U.S. has zero interest rates. The Fed is expected to keep rates at zero for the foreseeable future. And more importantly, now the Fed is becoming the biggest seller of volatility because by buying $1.8 trillion of agency RMBSs, agency debt and treasury, is keeping also volatility on the long end essentially low, and that makes safe all these carry trade bets. So everybody's borrowing in dollar. The dollar is weakening. You can borrow at zero rates. Given the dollar weakening, you're actually borrowing at significantly negative rates, minus 15, 20%, given how much the dollar has fallen. And the traditional carry trade was just buying high-yielding currencies and assets, like in Turkey, in Australia, in Brazil, where interest rates are higher. But now you can do the same carry trade in oil, energy, commodities, in global equities, in credit, in almost every risky asset class.
Right.
And this asset bubble we have seen since March, where asset prices have gone up globally across the board in a perfectly correlated way by 60% or 100% more in emerging market, is explained by this huge, massive mother of all carry trades, where the U.S. dollar has become the funding currency for them.
So the fact that the dollar is at or close to a one-month high does not change your view in any way. There's no way that the dollar could suddenly revalue up and pop, or at least deflate some of this bubble.
Well, the dollar moves trend-wise down and has been falling since March significantly. There has been slightly of a correction of the dollar upward, but that's really minor. My concern is that this carry trade is going to continue for a while, because as long as the Fed is on hold, expect to stay on hold, and as long as the Fed keeps volatility on the long end of the yield curve low, then volatility is low, and it's safe to take these carry bets and do it more and more again. Now, there is going to be eventually an unraveling of this carry trade, and once that's going to occur, you'll have a very sharp snapback of the dollar, like it happened a couple of years in the case of the yen, when carry trade unraveled. And when that snapback of the dollar is going to occur, it's not going to be 2% or 3%, it's going to be more like 15 or 20%, and then everybody will have to close their shorts on the dollar, they'll have to sell these risky assets across the world, and you could have a huge asset bubble going into an asset bust. I don't expect that, however, to occur in the short run, because for the time being, the Fed is on hold, expect to stay on hold. It's not even finished to buy all the treasury and agency debt.
Right.
So it's going to eventually occur, but it's going to be 6 months from now or a year from now. In the meanwhile, the bubble is going to become bigger globally, and the bigger is the bubble, the bigger is going to be the crash.
Can this be orderly, Nouriel, in your view? For instance, if the Fed changes their language, maybe not today, but early next year, can they project some clarity to the market to the point where the dollar does not snap back so violently?
I worry that as soon as there is going to be a shock, like the Fed signaling they're not going to buy any more treasuries or MBSs, or the Fed is going to start increasing rates, or you could have other types of surprises. Like, for example, if we're going to have a U-shaped kind of recovery or a double dip, then there'll be an increase in risk aversion. And like last year, when risk aversion goes up, the dollar snaps back. So right now we're creating such a large amount of carry trades, and everybody believes they're smart because they're long in risky assets, and they say, I'm keeping my finger on the trigger, and I'm going to get out of it as soon as there is a significant reversal of the dollar. But it's like a rush to the exits. When everybody's going to try to do it at the same time, there'll be a stampede, risky assets are going to collapse, the dollar is going to snap back. So the risk is that there is not an orderly way of doing it, unless you more aggressively signal, and central banks are not doing it, they're going to phase out this quantitative easing sooner rather than later. But that's not what the Fed is telling us. That's not what other central banks are telling us.
You know, Nouriel, obviously the carry trade has played a big role in what's been happening. But correct me if I'm wrong, it seems like your thesis kind of counts out any ideas that some of this growth in the overseas markets is coming because they've seen real growth. They've seen a lot of spending. They are still buying and snapping some of this stuff up. Do you discount any of that in the equity build that we've seen around the globe?
No, I totally agree that of the increase in risky assets, including equity, a good chunk of it could be due to fundamental improvements. You know, we avoided near depression. Asset prices should be higher. There's light at the end of the tunnel, regardless of whether it's a V or U-shaped recovery. Asset prices should be higher. We're now having lower risk aversion, and therefore investors are moving away from less risky assets like short-term treasury into equities, commodity, credit, emerging market asset classes. So part of that increase in asset prices is fundamental, but has become so rapid, so fast, and so perfectly correlated across the world. And EM asset prices have gone up by 100, 150%. There's a real evidence right now in China and Asia. Real estate, commodities, equity are getting out of hand. Price-earning ratios are out of hand. So it's a signal of a bubble, and that's what many policymakers in this country are also concerned about. There's a clear case that part of this increase in asset prices is not just fundamental, but is the beginning of a very risky asset bubble, like we had before, and we know what happens when an asset bubble goes bust, and now it's global. It's not just a U.S. asset bubble.
Yeah. Professor, I want to just move you to another topic. Where are we on the housing market? As the nation's housing market bottomed out, are we poised for a recovery, or is it worse yet to come?
Well, the quantities have bottomed out because both demand and supply has fallen by 80% from the peak, but the gap between supply and demand is so large that I expect home prices are going to fall another 10% until the end of next year, because you could stop producing new homes for a year. It'll take you a year to get rid of the inventory. And for existing home sales, a third of them are still distress sales, short sales, or sale of foreclosed homes. And there are two other factors that are going to fall the prices. There has been a boost in demand, is temporary because of the first-time home buyer tax credit. That's going to be phased out. Two, there's a huge inventory, about 3 million shadow homes that are not yet being foreclosed because there is a moratorium on foreclosing. But all the modification, two-thirds of them end up eventually in default and delinquencies and foreclosure. So next year we'll have a huge increase in supply. Demand is falling again once the tax credit is appearing. So the price adjustment is going to continue. I expect that the cumulative fall in home price is going to be 40% at the peak as opposed to the current 30%. And commercial real estate is even worse than residential at this point.
So, Nouriel, I'm guessing you don't believe there's any chance that economic fundamentals, jobs, housing, anything like that, CapEx, business investment, can catch up in time for this bubble not to happen?
Well, my fundamental view is there's going to be a recovery, but it's going to be U-shaped rather than V-shaped, because the labor market is extremely weak. There is no labor income. The consumers are shopped out, saving less and debt burden. They have to save more, consume less. That means lower growth. Capacity utilization is 70%. Why would anybody want to do CapEx when a third of capacity is not utilized? And globally right now you have a situation in which the overspending countries like the U.S. are retrenching, while the oversaving countries like Japan, China, Asia, Germany are not compensating with an increase in their own demand, and that means lower global economic growth. Finally, the fiscal stimulus is going to become a fiscal drag by the middle of next year. So you put all these factors together, to me it looks like a U-shaped recovery when the markets are pricing in a V-shaped recovery that I don't see in the data.
Nouriel, your critics will say, all right, now Roubini is trying to find a framework in which to explain the huge market rally that he missed since the beginning of the year.
Well, as I said, the fundamental explain part of the market rally, but if you look around the world, tons of policymakers in Asia and Latin America are becoming so worried about this hot money flowing in. They're intervening aggressively with spot and forward intervention. They're intervening, like in Brazil, with essentially having capital controls. And at the G20 meeting of the finance ministers and governors of the central bank, this issue of the asset bubble is going to be front center of their own debates. It's not just Roubini is worrying about it. Right. Globally, people are starting to worry about it because it's getting out of control. That's the reality of it.
Nouriel, we always love hearing from you. It's a good point of view to listen to. We'll be looking forward to hearing about your speech later today.
Good talking to you.
Nouriel Roubini.